You don't spend more than 200 crore rupees without making people notice. Especially when you're Piyush Bansal, the founder of Lenskart, India's biggest eyewear brand. Back in July, he made a move that turned heads across the investment world. He quietly bought more than 40 million shares of his own company. And not just from anyone, these came from the company's marquee backers like SoftBank, Temasek, and Kedara Capital. And the kicker? He paid only 52 rupees per share. That was basically just 1/10 of Lenskart's last private valuation. Think about it. He bought low, and now, as Lenskart gears up for an IPO expected at $9 to $10 billion of valuation, his stake has grown from 7% last year to 10.3% today. Buying cheap shares from investors only to sell expensive ones to go public. On paper, that is a dream trade. But this is not just about opportunism. That extra 3.3% gave Bansal something more than just equity. You see, it pushed him over the 10% threshold that makes him now, under Indian rules, a promoter. And he is not alone. In December, Gaurav Kushwaha of Bluestone did something similar. He spent 75 crore rupees to push his stake higher. Different amounts, different timing, same goal. Promoter status. So suddenly, 2025 seems to have become the year of founders clawing back their equity. Dozens of new age tech IPOs, founders reshaping their roles, and a regulator that, believe it or not, is nudging them in this direction. So here's the big question. Why are India's startup founders who once ran from the promoter tag now fighting to wear it again? Welcome to Daybreak, a business podcast from the Ken. I'm your host Snigdha Sharma, and I don't chase the news cycle. Instead, every day of the week, my colleague Rachel Varghese and I will come to you with one business story that is worth understanding and worth your time. Let's start again with Piyush Bansal. Lenskart has raised over $1 billion in the last 15 years. And along the way, investors like SoftBank and AlphaWave cashed out through secondary exits. So when Bansal wanted to buy back shares, those same investors were surprisingly open to selling at a discount. If you're wondering why, that is because they had already booked their returns. In Lenskart's case, every investor sold shares in proportion to their holdings. Some founders even negotiate these terms right early on, clauses that allow them to repurchase equity at milestones like an IPO. But even then, it is not easy. One unicorn founder admitted to the Ken's Arundhati Ramanathan that he had to fight tooth and nail to get such terms. And that is what makes Bansal's deal stand out. The sheer scale, the timing, and also the bargain. Compare that with Gaurav Kushwaha at Bluestone. He didn't get a discount. He paid 578 rupees per share, which is more than Bluestone's IPO price band. And he pushed his stake from 12% to 17%. Because SEBI, India's regulator, requires promoter groups to hold at least 20%. He and another co-founder had to cross that line. So some founders are buying cheap, others are paying premiums, but the destination is the same, promoterhood. And here is where things get interesting. Because only a few years ago, in 2021, SEBI actually tried to move India away from the promoter model. Remember when Paytm, Policy Bazaar and Nykaa went public? Back then, SEBI said that companies could list without an identifiable promoter. Ownership, they argued, was shifting to institutions and professional managers. The promoter family archetype was supposed to fade away. And founders loved it. No promoter meant fewer rules, less disclosure, and the freedom to still receive ESOPs, those lucrative stock options. But then Paytm happened. Its rocky post-IPO journey rattled everyone. By 2024, SEBI had flipped. It wanted accountability. If you are the face of a company, you should be the ones that investors can hold responsible when things go wrong. So now, founders are leaning in, buying back equity, pushing past the 10% mark, and claiming the promoter tag that SEBI seems to want them to wear. Stay tuned for more on this. Of course, not everybody thinks that this is a good thing. One founder turned investor was blunt. He called it a wrong habit. And his point was that if you diluted heavily while raising money, that was the trade-off. You get the benefit of capital, but buying back shares later at a discount just before an IPO shifts the cost onto new investors. In his words, it sets a bad precedent. It's not like he was criticizing people like Kushwaha at Bluestone who paid above the IPO price, or even Ritesh Agarwal of Oyo who famously spent $2 billion to rebuild his stake. Painful, maybe reckless, but at least not cheap. The criticism is aimed squarely at the Bansals of the world who managed to scoop up equity at fractions of the company's last valuation. And yet, these deals keep happening because the incentives are stacked that way. Investors who already took money off the table are willing to sell cheap if it smooths the road to IPO. Founders, meanwhile, regain control and the title of promoter. But the promoter status is not free. As tax consultant Ajay Roti explained to my colleague Arundhati, it comes with costs. More disclosure, lock-ins of at least 18 months, and no ESOPs, the very stock options that many founders prize the most. One unicorn founder even said, even if I had more than 10% stake, I wouldn't have chosen to list as a promoter-run company. With ESOPs, the upside was better. So, why are some still doing it? Two reasons. One, SEBI has softened the rules. Founders who became promoters can now retain ESOPs granted a year before filing IPO papers. And two, SEBI itself is nudging companies. Draft IPOs with identifiable promoters actually get faster approvals. Then there is also the shadow of Paytm. When Vijay Shekhar Sharma cut his stake below 10% and awarded himself 21 million ESOPs, SEBI stepped in. It suspended the grant, fined him, and sent a clear signal. It was not comfortable with no promoter IPOs. Since then, the regulator has leaned harder on the promoter model because promoter classification is the backbone of its rulebook. It governs related party deals, insider trading, disclosures, and takeover rules. Without a promoter, a founder could sidestep these checks. That is why investors too are stepping aside. None of them want the liabilities of being tagged promoter. Better to let the founder take it. Some even joke that they would give away shares for free to avoid that responsibility. So, here we are. Founders like Bansal and Kushwaha are leaning into promoterhood, regulators are encouraging it, and investors are not resisting. And at the end of it all, the market gets what the market wants, a clear neck to catch. Because for all the debates about valuations, buybacks, and ESOPs, one thing is clear. Public investors want to know that when a company lists, the founder is still championing the vision, not just on day one, but long after the roadshow is over.
Daybreak is produced from the newsroom of The Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription unlocks daily long-form feature stories, newsletters, and podcast extras. To subscribe, head to theken.com and click on the red subscribe button on top of the Ken website. Today's episode was hosted by Snigdha Sharma and edited by Rajiv CN.